Imagine an investor holding a highly appreciated, fully depreciated commercial asset. Over the years, the property has performed exactly as intended, generating steady cash flow and significant equity growth. Eventually, that investor reaches a point where they want to exit. They are ready to liquidate the asset to shed the active responsibilities of dealing with tenants, property management, and late-night repair calls. This diagram shows exactly what happens upon liquidation. Selling triggers an immediate, massive taxable event. Capital gains taxes take a severe cut right off the top. But the larger threat is often depreciation recapture. The IRS taxes the depreciation claimed over the life of the property at a high ordinary income rate. Combined with capital gains, this severely erodes the investor's principal. The traditional method to avoid this tax erosion is a 1031 exchange, allowing the investor to defer both taxes by rolling the proceeds into a new, like-kind property. The problem is that buying another direct property deceits the investor's original goal. It simply trades one set of active landlord headaches for another. Preserving the velocity of that capital requires the 1031 exchange. Achieving true passivity, however, requires moving beyond the structure of direct property ownership entirely. For time-constrained 1031 exchangers, the Delaware Statutory Trust, or DST, provides a structural solution. This diagram illustrates the core mechanics of a DST. It is a legal entity that holds title to institutional-grade real estate. Instead of buying the building, investors purchase beneficial interests, equal fractional shares of the trust itself. The critical detail is how the tax code views this arrangement. For federal income tax purposes, the IRS treats the ownership of these fractional shares as direct ownership of real estate. They are not classified as securities or partnerships. This provides pure passivity. Unlike traditional real estate syndications or tenant-in-common structures, the DST sponsor is solely responsible for arranging debt, securing leases, and handling all day-to-day operations. The DST offers perfect tax deferral and complete passivity, but surviving IRS scrutiny and maintaining that 1031 eligibility requires the trust to operate under extreme, legally mandated rigidity. The legal viability of DSTs hinges on a specific pivot point in tax history, IRS Revenue Ruling 2004-86. The ruling established a central mandate. To remain eligible for a 1031 exchange, the DST must be classified strictly as a passive grantor trust. It cannot engage in activities that would classify it as an active business entity. If the trust crosses that line and acts like a business, the consequence is immediate reclassification. The trust loses its grantor status, voiding its 1031 status, and triggering a massive, unplannable taxable event for every investor involved. This diagram maps the perimeter the IRS built to prevent that reclassification. It is defined by the 7 deadly sins, 7 strict prohibitions designed to ensure the trust remains entirely static. These are not sponsor guidelines or operational best practices. They are absolute legal walls that dictate the entire risk profile of the investment. Constraint 1 is an absolute prohibition on accepting additional capital contributions once the offering is closed. This rule protects existing investors from equity dilution. It forces the sponsor to fully capitalize the trust, including all anticipated reserves on day 1. Constraint 2 prohibits the trust from securing new borrowing or renegotiating existing loans. This creates a specific operational risk. If a loan matures during a down market, or the asset faces a severe cash shortfall, the sponsor cannot legally refinance their way out of the problem. Constraints 1 and 2 strip the sponsor of the 2 most common tools used to rescue struggling real estate: capital calls and refinancing. Constraint 3 removes leasing flexibility. The sponsor cannot enter into new leases or materially modify existing ones. The sole, narrow exception to this rule allows for lease modification only in the event of tenant insolvency or bankruptcy. Constraint 4 is a strict ban on making significant capital improvements or expenditures to the property. The IRS draws a hard line between legal, ordinary maintenance, like repairing a damaged roof, and prohibited value-add improvements, like upgrading units to increase rent. Together, these operational freezes mean the sponsor cannot actively manage their way out of a bad market. The asset must perform strictly as underwritten. Constraint 5 prevents the trustee from reinvesting proceeds from the sale or refinance of the property. Constraint 6 mandates that all excess cash generated by the property must be distributed to the investors. The trust cannot hoard cash to build a war chest for future acquisitions or to cover major unforeseen contingencies. Finally, Constraint 7 is a catch-all rule, prohibiting any operations that would classify the DST as an active business. By legally binding the sponsor's hands across all 7 points, the IRS guarantees the investor's capital is purely passive, strictly adhering to the exact requirements of the 1031 exchange. This raises a critical investment question. If a sponsor cannot raise money, refinance debt, remodel the building, or change the leases, what kind of property can they actually buy? Take the concept of value-add real estate. This strategy relies entirely on heavy renovations and tenant turnover to force appreciation over time. Assets requiring that level of heavy operational involvement are strictly prohibited for a DST, as executing the business plan would immediately violate the constraints on capital improvements and lease modifications. This diagram shows a filter created by those constraints. Volatile, management-intensive properties bounce off the restrictions. The only assets that can legally survive the filter are fully stabilized properties. These stabilized assets form the core of modern DSTs. You see this in long-term net lease medical facilities, institutional multifamily complexes, and newly built industrial distribution centers. The extreme rigidity of the DST acts as an aggressive risk mitigation filter, legally forcing capital into defensive, conservative assets. A standard 1031 exchange comes with intense timing pressure. An investor has just 45 days from the sale of their original asset to identify a replacement property. This timeline tracks that window. Identifying and closing on direct commercial real estate within 45 days is highly prone to failure. Because DSTs are pre-packaged securities, an investor can identify and close their position in a matter of days, completely removing the timing risk. Once closed, the capital enters an illiquid holding period, typically lasting 5 to 10 years, during which the investor receives passive monthly cash flow distributions. The holding period ends when the sponsor eventually sells or refinances the underlying asset, liquidating the trust and returning the principal. Upon that exit, the 1031 window opens again. The investor can exchange those proceeds into another DST or transition back into purchasing direct real estate. The DST functions as a temporary, tax-protected bridge that allows wealth to safely span market cycles while maintaining its deferred status. The mandatory trade-off for this level of extreme passivity is total illiquidity and a complete loss of control. There is virtually no secondary market for DST beneficial interests. Once committed, the capital is locked inside the structure until the sponsor initiates the exit. Because the investor cannot intervene, rigorous sponsor due diligence is required up front. Evaluating the sponsor's track record, careful debt structuring, and leverage ratios is the only way to manage risk before the capital is frozen. For high net worth investors, the Delaware Statutory Trust is a precise tool. It strips away active property management and defers capital gains without triggering depreciation recapture. By understanding the legal architecture and the constraints that govern the trust, investors stop seeing the rigidity as a risk. Instead, they utilize it as a deliberate mechanism for hands-free wealth preservation.